I guess, Shri, this is really a nod to just how much bigger the PE and private credit universe have gotten.
No, that's absolutely true. Look, sometimes there is a temptation to assume that when a large organization makes a lot of personnel changes, it is just to shake things up. People get bored, they want to do stuff, keep it exciting. But this is different, right? BlackRock manages $9 trillion in assets. So in some ways, the alternatives business is a niche there, which is a $300 billion business. But the alts business, a number of the alternative investment firms that we've seen over the last couple of decades have done really well. In fact, the previous decade was all about these alternative investing firms, the Blackstones, the Apollos of the world. BlackRock obviously sees a lot of demand there, but unlike other asset managers, you had your traditional fixed income, your equity, and then you had this big box called alts. Now they're saying, people are focused on what part of that universe they want to invest in. So they're getting rid of, or more or less getting rid of this bucket called alts and distributing credit, the liquid credit under Rick Rieder, who's someone we know. Then private equity and like the direct equity investing stakes, the opportunistic credit and the direct lending, the private credit market, because that's one part of the business where they're seeing a lot of interest. And that's why they're reorganizing their structure to try and capitalize on that.
So alternatives actually is a misnomer because it's not really alternative anymore. Romain was in LA talking to a lot of asset managers, and pension fund managers are all talking about how they're putting money, allocating money into things like private credit, private equity.
Yeah, if you think about the Milken crowd, anyone who goes there, it would be a complete misnomer to consider them sort of outside the conventional lines of finance. They are conventional finance now.
We'll talk about how you, though, tailor-make these products, because I think the reorganization of BlackRock seems to kind of be hitting at that idea here that, of course, you had this big umbrella. It was once a small umbrella. Now it's this big umbrella of assets, and you can't really market it as this big one thing anymore. You have to have it much more tailor-made. And we heard that a lot from a lot of the LPs and some of these funds basically saying they want to see a little bit more niche, if you will.
It was a small umbrella. It is a bigger umbrella. It is not a big umbrella. Of the $300 billion in alts, about $84 billion of that was already liquid credit, your conventional high-yield credit, leveraged finance, CLOs. Again, 20 years back, they might have been novel products. Now they're as mainstream as they get. What they did call out are two important areas.
What's
the
that?
Direct equity stakes and investing business.
Yeah.
That's where they're seeing a lot of interest. And private credit, which they're not the first firm to talk about it, but they clearly recognize the opportunity there.
Private credit, we're talking about direct lending?
Exactly, direct lending. And that's why they have shifted the person, Jimmy Keenan, who ran all of their credit business, and tasked him with focusing just on this private credit business.
I think, and it's interesting because we bring that up. We were talking a little bit earlier. It was Blackstone and the idea that they're looking to partnership with some of the regional lenders here to, I guess, continue down into that space here. What's sort of the end game for them here? Because at some point there is concern about regulation, right? That the shadow banking system is really not in the shadows anymore. It is the system for the most part here. And if they do push these products to a level where we get that exponential growth that we saw over the last 10 to 20 years, over the next 10 to 20 years, should they be expecting additional regulation?
There might be additional concern. There might be a lot more scrutiny. But the fact is, these markets are growing. And it doesn't seem like a cyclical thing. This is a secular change that's taking place. Previously, if a company had to borrow money, it went to the bank. The bank kept that on its balance sheet. A lot of that has changed, right? That is why we have a thriving leveraged finance market. And some of these other changes, the growth of the private credit market, it's hard to see a catalyst right now that would put an end to it.
Yeah, and I'm glad you bring that up because I think about what's going to drive these alternative businesses, the private businesses, further. And certainly cheap debt helped fuel private equity. Debt is less cheap than it used to be. When it comes to private credit, talk a little bit about how the tighter regulations on banks and the tightened standards for banks is really going to drive private credit in the coming years.
It's been a trend you've seen over the last decade. The banks have to be careful about how much lending they can do. They have to set aside capital for the type of lending that they do. So they are somewhat constrained. But there are these other players who have long-term capital, locked up capital that they can put to work. And then eventually you will see good returns, or at least they've seen good returns. And even though interest rates are being jacked up, and this is not the zero interest rate policy environment we were in a few years ago, it is still a conducive environment for the growth of this private market.